Hello, everyone, and welcome to the first Convera Global FX Outlook webinar for the year. We have these webinars, of course, each month in the first week of the month. Skip it in January and back again now. So certainly looking forward to presenting to you all. But first of all, we'll give it another couple of minutes, let everyone join the webinar, and then we'll kick off. Thank you. Okay, it's 3:01, at least in the eastern seaboard of Australia. It's 12:01 in Hong Kong and Singapore, but I'd like to say thank you for everyone for joining today. My name's Stephen Dooley. I'm the head of market insights at Convera, and really looking forward to presenting to you today. Of course, the focus of the monthly Global FX Outlook webinars is to look at some of the big drivers in financial markets, why we are where we are now. Look at the calendar for the month ahead, what's going to be the drivers for the next few weeks, and then having a look at some of our key FX markets and forecasts for the year ahead. So that can help you plan. Importantly, it can help you identify the kind of volatility that we expect to see in markets. When we present our forecast, we don't present just an end of year rate. We also provide that range that we expect, a core range, and then what might happen if we get a sudden big move in either direction. Financial markets are volatile. Of course, the Australian dollar, since it's floated in 1983 as an example, moves about 18% per year on average. So that's a big range. And so we should be prepared whether we're in Australia, New Zealand, Singapore, Hong Kong, or out of the US and Canada for a volatile 12 months. Historically, FX markets do move significantly. As I said, not just me today, I'm the head of market insights here at Convera. We've got Shirley Lim, who's our FX and macro strategist, who will be covering, for APAC, who will be covering some of our APAC currencies today. As I mentioned, what we are looking at today, first of all, the global economic outlook. What's been the big drivers in financial markets? We'll move on to APAC, we'll move into North America, and then we'll think about some considerations for global businesses. This is, of course, the webinar is based on the Global FX Outlook document. You can see that in the resources tab of the webinar, so please download that. That also comes out in the first week of each month, and that can help you. We'll walk through the report in this webinar, and that can help you identify where there's value, where a market is overvalued according to its historical averages, where it's undervalued according to its historical averages, which markets are seeing the most volatility. And again, as I mentioned, those FX outlooks that and forecasts, which are absolutely key. And then at the end, any questions or answers, please feel free to use the Q&A tab on your Zoom controller. Happy to answer any questions. And we're looking really to have this done and dusted in about half an hour or so you can get back to your business. All right. What happened in January? What's been the big driver so far this year? Well, it's pretty clear the big story has been the US dollar. The US dollar collapsed in the last part of last year, fell about 5% through October, November, December. But in January, a really big improvement in the US dollar, up 4% from those lows at the end of December, and two big drivers of that. First of all, US economic data has been really strong in January. It's really staged a comeback. Just goes to show that the US economy keeps really outperforming. And as that data was strong, it caused the market to expect that the Federal Reserve is less likely to cut rates now in March. Going at the start of the year, there was about an 80% chance of a rate cut in March. Now it's about 15%. So markets don't believe we'll get a rate cut in March from the US, and that's pushed the US dollar strongly higher so far this year. Just the US economy really strong. In other markets, the British pound was interesting because it held on pretty steady around that 128 level versus the US dollar, and in quite a tight range as well. It drifted a little bit lower in the first couple of days of February. But the UK inflation is high, wages are high, markets are less convinced that we might get rate cuts from the UK. So the British pound's been pretty strong, steady versus the US dollar, but higher versus most other currencies. The euro, on the other hand, a little bit weaker, and the European Central Bank has signaled that they're more and more concerned about slowing growth, particularly out of Germany, the largest economy in the Eurozone. Another very poor result for its fourth quarter GDP. And if you look at the major European economies, Italy, France, Germany, all really underperforming at the moment. So that's why the euro is underperforming. And the Australian dollar, mostly weaker as well. And that really is a driver. The driver of that has been the weakness out of China. We're going to touch a little bit on particularly the Chinese economy in today's presentation, but Chinese shares in particular have faced a monumental sell-off so far this year. Markets very concerned about growth expectations. Property is still a major negative in China, and so that weakness in Chinese shares has really weighed on the Aussie dollar. Down to 6-week lows, a little bit of a rebound yesterday as the Reserve Bank of Australia suggested that they might still need to raise interest rates. That was then. This is now the big events for the month ahead. It's actually a bit quieter. And of course, as I mentioned, we've already got central bank decisions from the Bank of Japan, the Bank of England, the European Central Bank, and the Federal Reserve in January. So February's a little bit quieter. All the central banks meet again in March. So a little bit quieter over the course of February. What's going to be really interesting is these PMI numbers, the global purchasing manager index numbers. They're all out around the third week of February. And what they're going to tell us is if this rebound that we saw in January, it wasn't just in the US. We saw a bit of a rebound in January with some of the sort of real up-to-date data points, as I say, like those purchasing manager indexes. Those more up-to-date data points have shown an improvement in January. So if that can continue to higher in February, there'll be a real positive for global growth. And it might mean that central banks aren't able to cut as much as markets are looking to. Okay, so let's look at the big factors driving the economic update, the economic outlook at the moment. And first of all, the most incredible story in 2023 was how quickly inflation has tumbled. The reason why markets believe central banks can cut interest rates is because they raised rates really quickly in 2022 and 2023. And you can see this was when they were raising interest rates. And since then, inflation has collapsed. The key number is in purple here. This is the overall headline inflation. And you can see this has fallen from near 9% at the end of 2022 to around 3% at the end of 2023. So one of the all-time most incredible drops in inflation, particularly without a recession. So that's why central banks now have the opportunity to cut rates. Rates were probably right when we were up here. Rates should be lower if inflation is down at these levels. So that's why markets are so focused on the expectations for rate cuts. A couple of things to notice. Of course, you've all heard that the big driver initially out of inflation was goods inflation, as everyone looked to buy products during lockdowns, and supply chains couldn't handle it, pushing the prices up. You can see goods inflation really topped out in the middle of 2022 and is really right down the bottom, near 1% now. So that goods inflation is done and dusted. The other inflation is the services inflation. That tends to be a bit stickier, and you can see that that took a longer time to go up, and it's now still the highest here, around about 4%. So central banks that say we're not quite ready to cut rates now, the reason they say that is because services inflation hasn't come down. And if we start to get services inflation down to 3% or 2%, then central banks will probably start cutting like there's no tomorrow. Now, what's interesting is that inflation around the world has really moved in a uniform manner down. So where are we getting the difference between economies? Well, it's actually in wages. And you can see again why markets believe that the US might be able to cut rates before anyone else is because their wage growth is really starting to decline. So wages are an important component in inflation. And if inflation is coming down and wages are coming down, well, then you've got the opportunity to cut rates. But if inflation is coming down, but wages are still going up, like in the UK, like in the Eurozone, and like in Australia, then that might give you pause to thought. And that, as we go into 2024, might be what drives a difference in timing in central bank moves, and that's what could drive some really big moves in FX markets. If the Federal Reserve starts to cut, and for example, Australia or the UK are less keen to cut rates, if they keep rates higher for longer, then we can see a big bounce in the pound versus the US dollar and a big bounce in the Australian dollar versus the US dollar. So this year, it might be wages growth that's even more important in terms of central bank moves than inflation, which of course, inflation has been the dominant story in the last 2 years. So as I said, expectations for central banks have just completely turned. Have a look here. In the middle of 2022, markets were looking for around about 750 points of hikes from the Fed, from the Bank of England, and from the ECB. Now they're looking for around 600 basis points of cuts from the Fed, from the Bank of England, and from the ECB. So this is the starting off point for the year, and how those expectations change will be how the moves in FX markets develop this year. Roughly, as a rule of thumb, everyone's looking for around about 200 basis points of cuts for each central bank over the next 18 months or so. So that's 18 months. We're looking at 24 months here, but for this example, over the next 18 months, and it's all roughly the same. There's slightly fewer cuts priced in the Bank of England, slightly more priced into the European Central Bank, but overall it's about 200 points each. Now, that's the starting off point, and that will move over the course of the year. And as I said, if the Federal Reserve can deliver, then that can keep you can see the US dollar weaker. If the Bank of England doesn't, that can see the pound higher. So this can drive really sharp, big moves over the course of this year. And in the first half of this year, that's probably going to be the driver. And it does have the capacity to drive big moves in markets. If the Fed cuts 3 times over the next 6 months and the Reserve Bank of Australia doesn't, then the Aussie can just bounce from 65 now to 70 cents in the blink of an eye. And so that's the kind of moves that we might see over the course of 2024. Of course, mentioning the Aussie dollar, for a sustained move above 70 in the Aussie dollar, we need a rebound in the we need a rebound in the Chinese economy. And this is the most stark example, I think, of just how much the Chinese economy has underperformed over the last couple of years. If you look at the start of January 2021 and start at zero, US shares up 32%, European shares up 21%, but in China and in Hong Kong, China down 39%, Hong Kong down 43%. So it's really stark that if you look at the globe, the real underperformance is out of China. Of course, some of that collapse in goods inflation was driven by a collapse in goods demand. That's part of it, but it's really this property market hangover that's really hitting Chinese equity markets. As we enter the new year with the Lunar New Year, perhaps we might start to see more stimulus from the Chinese authorities, and that could see a rebound in Chinese equities and could be a positive for global growth and the Aussie and Kiwi in particular. So that's going to be the big event, I think, after the Lunar New Year. How do markets play out? How does China play out after that? Now, I was mentioning central banks and I was mentioning rate cuts and I was mentioning China. That's probably the first half of the year story. The elephant in the room, of course, is in the second half of the year that geopolitics could come to the forefront. I mean, some would argue it already is. We've got ongoing, the war in Ukraine, the Russian invasion of Ukraine remains in place. The conflict in Israel and Hamas has become a clear crisis. The Houthi rebels have drawn the US Navy into some of its most treacherous confrontations in decades. So geopolitics is already a concern. But of course, as we go to the end of the year, the US presidential election, you can see how much uncertainty, looking at the policy uncertainty index, this is how it normally plays out over the course of the year. But in election years, US presidential election years, you can see this big step up in uncertainty over the course of the year. So uncertainty in FX markets tends to see risk-sensitive currencies like the Australian dollar, like the Chinese yuan weaken, and safe haven currencies like the Japanese yen and the US dollar strengthen. So that's a risk as we go into the back half of this year. So clearly, interest rates, the driver in the first half, geopolitics, the driver in the second half, both can create high levels of volatility. So I think we do need to be prepared for the risk of greater volatility in 2024, certainly compared to 2023, what was a lower than usual inflationary outlook. Okay, so that's the economic story. So let's drill down a little bit more into FX markets and drill down here. So in terms of volatility, again, the Aussie and the US, Kiwi US and the Aussie US really at the height of volatility. And both of those currencies tend to be driven by interest rate expectations. And in the US, as that strong data caused markets to reevaluate the expectations for a rate cut. Like I said, we started the year thinking about an 80% chance for a March rate cut. We're now about 15%. As US bond yields rose, the Aussie and the Kiwi fell. So Aussie and the Kiwi really the big underperformers in markets. Perhaps unusually as well, the Aussie CNY also saw quite a bit of volatility over the last 3 months as well. Looking at the lower end of the range, the US dollar CNY less so, and the Kiwi and the Aussie really stagnating there at the moment because broadly, most forecasters and markets expect the Kiwi central bank and the Aussie central bank to move broadly in lockstep, likely to keep rates higher for longer this year, and then maybe start cutting towards the end of this year. In terms of the value in the Aussie dollar, story hasn't changed with the Aussie yen nearly more than 16% above its 5-year average. The Japanese yen remains extremely weak, It's the only central bank that hasn't lifted interest rates. Well, only developed central bank that hasn't lifted interest rates over the pandemic. And as a result, the Japanese yen has been significantly weak versus most currencies. That might change because the Bank of Japan is talking about raising interest rates. Not much, maybe from minus 0.1, where their benchmark is, to 0, but it can have a big impact. So that's going to be one to watch this year. The Aussie yen might fall, and other yen pairs might fall as well, fall from their recent highs. To the downside, I mentioned the pound was really strong over the last couple of months. It hasn't climbed a lot versus the US dollar. It's been steady versus the US dollar, but it's been higher versus most other currencies. And you can see it's higher here versus the Aussie dollar. And of course, at the bottom, in terms of where it is versus its historical averages, Aussie US really under pressure, about 3% below its 2-year average and about 6% below its 5-year average. So what does this mean for the future? Well, as I said, the Aussie dollar expectations is for the Aussie to move back higher over the course of the year. And that's partly, as you can see in the central scenario here, the RBA's resistance to rate cuts. And we got that yesterday from the Reserve Bank. The new governor, Michelle Bullock, came out to say that there's more work to be done to get inflation lower. Australian headline inflation at 4.1%. The target for the RBA is for it to be between 2 and 3%, and the RBA doesn't see it getting back to that range until next year. So as a result, that's what's keeping the expectations for the Aussie dollar higher. Like I said, can we push significantly higher? Can we go above 70? Well, the upside scenario, A, Chinese support, B, if US inflation slows down further than anticipated, that can help the Aussie dollar higher as well. So that's a real potential scenario that gets us back to 70 or higher over the course of this year. Now, before I move on, don't forget that all these forecasts and more are in the Global FX Outlook document. You can get that from the Resources tab on your Zoom controller or on the Convera website, or speak to your Convera representative. In the Kiwi US, similar story where the Kiwi Central Bank, the Reserve Bank of New Zealand, is also worried about high inflation. We got employment numbers today from the New Zealand economy. They were stronger than expected. And again, it just builds into the case that we mentioned earlier, that even though inflation's coming down, there are other dynamics to look at, particularly wages. And with unemployment low, with employment growth high in New Zealand, it just doesn't give the Reserve Bank of New Zealand much of a chance to cut. So that's the potential this year that can push the Aussie or push the Kiwi higher, is if we get the Reserve Bank of New Zealand likely to remain steady. Okay, so that's it for me for now. I'll pass on to Shirley, and Shirley can cover some of the key markets around the APAC region. Shirley.
Well, thank you, Stephen. Starting with the yuan, the US-China yield differential continues to be a major driver of the yuan's value. Market expectations of further PBOC easing have put downward pressure on the currency. However, comments from Chinese leadership emphasizing currency stability have added more nuance to the outlook. This suggests that the PBOC may take a balanced approach. Fundamentally, China's deflationary environment provides room for monetary policy accommodation, but sudden sharp falls in the yuan could risk destabilizing capital outflows. Looking ahead, we do see scope for further yuan depreciation driven by policy divergence with the US, but we do not expect these orderly declines beyond thresholds that might spur policy responses. The PBOC will likely aim to strike a balance between the currency stability and supporting China's economic recovery. Now switching gears to Sing dollar. The Sing dollar has shown resilience, staying in the upper half of its range over the past year. However, we see potential for some pullbacks toward the midpoint of the band, driven by global growth concerns weighing on risk appetite. The downside scenario risk for US dollar Sing could come from the Fed cutting rates more than expected, significantly weakening the US dollar. But overall, the mass appears comfortable with Sing's recent appreciation trend and has policy flexibility if needed. Barring any external shocks, the Sing dollar looks well positioned around its top of its range, though periodic dips on risk-off moves are possible. In summary, we see scope for further yuan depreciation driven by policy divergence, but no disorderly declines given China's emphasis on stability. For the Sing dollar-wise, the resilience is likely to continue, though some volatility is possible.
Thank you, Shirley. That was great. And as I mentioned earlier, all of these APAC FX pairs, the details, the commentary you've got there on the right of the screen, available in the Global FX Outlook document. I just want to touch on some of the key markets in North America before we go. Of course, the US dollar absolutely key out here, and a similar story like we mentioned in terms of where's the value out there at the moment in the US dollar Japanese yen pair, up 4% versus its 1 year average, up 7%, well 8% versus its 2 year average, and 23% versus its 5 year average. Now this is an interesting story because what's driven the US dollar Japanese yen pair so much higher has been this divergence in central bank moves. The US raising rates as the Bank of Japan kept rates flat. So as we look into this 2024 ahead, the potential for divergence if the US starts cutting rates while other central banks keep rates steady is where you can get big moves. So it's no coincidence that the biggest move that we've got in markets has been from two central banks moving in opposite directions. If we get this divergence in other markets, that's what can drive real volatility in 2024. So that's why the next move from the central bank and who goes next is so important. It's really clear that the biggest moves have been driven by that kind of divergence, and we're setting up for that kind of divergence again this year. In terms of the currencies, the US dollar has been strong over the last 2 or 3 years. So you can see that really the Euro, Aussie, and New Zealand dollar all well below their long-term moving averages. The Euro down 3% versus its 5 year average. The Aussie US down 6% versus its 5 year average, and the Kiwi down 7% versus its 5 year average. So clearly for buyers of those currencies, with the US dollar, some real opportunities out there at the moment. And like we said, the British pound holding up relatively well. You can see that here. We've mentioned this on a couple of occasions, but broadly steady, pretty much flat versus its year-to-date average, up versus its 1 year and 2 year, and just down slightly on its 5 year average. So pretty steady here from the British pound. Again, that's another market that can pop higher. And the fact that it's been relatively resilient over the last few months is a sign that maybe it's got the potential to push up higher over the next few months, depending on what we get from the Federal Reserve and the Bank of England. Quick focus on the other key markets, the Euro US dollar. We don't see too much opportunity for upside Euro gains in this market. Again, it's really going to come down to the central banks. We said that the euro might be a little bit behind the Federal Reserve, but it might only be a matter of weeks. We could see rate cuts from both of those central banks around the middle of this year. So again, that's what might result in a broadly flat euro US dollar. But that said, within that broad flatness, there's the opportunity for range trading to the top side up to around 111, and to the downside around 106. In the British pound, again, that opportunity, as we mentioned, broadly, as it has held steady, a steady view over the medium term, but it does have the capacity to move up to 128, 131, and to the downside, potentially down to around 121 over the course of this year. So certainly some volatility and clear opportunities out there for your pound buyers and pound sellers, depending on the kind of volatility we get for the course of this year. And then the US dollar versus the Canadian dollar, expectation that the Canadian dollar can strengthen over the course of this year, with a target down towards sort of 132, 131 by the end of this year, and down as low as sort of 126, 124 by the end of 2025. So again, as global growth picks up, as interest rate cuts flow through, commodity currencies like the Canadian dollar, like the New Zealand dollar, like the Australian dollar should benefit from rate cuts when they present themselves. Okay, so that's it for the economic outlook, for the outlook and focus on APAC currencies and North American currencies. So just to finish off, just what businesses should be thinking about this year. Well, first of all, volatility. We already mentioned that a real risk this year to see a pickup in volatility. And the important thing to think about is that in central bank moves, that central bank moves can drive very sharp volatility. So, we can see a 5% or a 10% move over a matter of weeks if we do see significant shifts in central banks. So again, that is the risk this year, and this is what you're looking to do to mitigate the impact of those risks with some of the currency risk management tools that we have available. Geopolitics, we mentioned, will be a concern this year, whether it be sort of the real politic of conflict that we've already seen this year, or whether it be the more traditional electoral politics in the back half of this year. Geopolitics can expose businesses to a whole range of risks, and we, of course, can help you with that. And then, of course, geopolitics often flows through into sanctions. And, of course, at the start of 2022, we saw a huge step up in the impact of sanctions after the Russian invasion of Ukraine. Again, that's an area where we can help with our automated global payment solutions, compliance controls, and fraud prevention measures. That's it for us for now. Wanted to see if we've got any questions. Feel free to ask questions if you want. We've got one in particular. We've got one here that is an interesting one. What's behind the US's outperformance? Well, there's a couple of factors. First of all, President Biden's stimulus package was the biggest stimulus package we saw as a percentage of GDP anywhere in the world apart from Singapore. So that's provided a huge influx of cash, around $5 trillion to consumers. And if you look what's been driving the US economy, it's been consumer demand holding up. Really unexpected as interest rates go up, but as I mentioned, driven by that stimulus support. And then two related factors. Equity markets in the US, incredibly strong, and really because of the so-called Magnificent Seven, whether it be Amazon, Meta, formerly Facebook, Apple, Microsoft, Alphabet, formerly Google. The really strong performance of those stocks has driven equity markets higher, but related productivity in the US has had a real rush over the last 2 years as well. And the better use of technology, and that has the potential to be accelerated even further with AI. So again, it's been one of the real fascinating factors in the post-pandemic world, is that the US economy has just continued to outperform. And even at the start of this year, it's really started to outperform as well. So again, interest rates and Fed moves will have a lot of the impact, but part of the reason why the US equity and the US dollar has been strong has been because of this very strong performance of the US economy. So if there's a risk to some of those views about early Fed rate cut driving the US dollar lower, that's certainly the base case, but strong US economic growth like we've seen over the last 2 years might provide a bit more support to the US dollar than most forecasters expect. All right, well, I'll wrap it up there. Thanks everyone for joining the call. I appreciate that. Now, the recording will be made available to everyone over the next 48 hours, so keep your eyes peeled for that. As I mentioned, the report is available in the resources section of the Zoom control, so feel free to download. It's also available on our blog section of our website as well. So with that, I'd like to thank you again for coming to the webinar. If you have any other questions, please reach out to your Convera representative. I'd like to thank Shirley for presenting today as well, and other members of the team for putting the webinar together, and look forward to speaking to you again next month. That's going to be on the 6th of March, so keep your eyes out for an invite in the short term. Thanks everyone. Bye-bye.